welcome everyone to another OptionsPath video. Today's just a quick video on using technical analysis when trading options. If you're not familiar with technical analysis, it's simply a method of analyzing and trading the markets with the use of charts like price patterns, trends, key price levels, and mathematical indicators, just to name a few. And these are all to try and get an edge in your trading. Now, many traders use elements of technical analysis to varying degrees of success. What we've found is that there are some elements, usually the simplest and most fundamental tools of technical analysis, that work far better than the more complicated and esoteric methods. What we've also found is that most options buyers tend to rely heavily on technical analysis. These are the directional options traders that buy calls and puts, or maybe debit spreads. Options sellers, on the other hand, for example, traders of credit spreads, iron condors, short calls and puts, short strangles, and the like, they may also use technical analysis, but not as extensively, because options sellers tend to rely more on probabilities, delta positioning, for example, and other option-centric considerations in their trading rather than on price and volume charts. Now, with that being said, all options traders, to one extent or another, can benefit from one of the primary cornerstones of technical analysis, and that is support and resistance right here. We at OptionsPath are both options sellers and buyers, but our bread and butter trading usually revolves around selling options. And when we use technical analysis in our options trading, the vast majority of the time, the method or tool we use is related in some way to support and resistance. Now, I'm not going to go through a long discussion of support and resistance here, as it's beyond the scope of this video, but let's discuss a very quick analogy to illustrate. Here I have a quick illustration of support and resistance and how you might want to look at it. Now, let's say that the market, whatever market it may be, whether it's an individual stock, an ETF, or a broad market index, let's say that the market price is like a bouncing ball, as we can see right here, that goes up and down all day long. Now, support can be thought of as a floor for that market price ball, where it may bounce back up when it drops down to that floor, as we can see right here. Resistance, on the other hand, can be thought of as a ceiling for the market price ball, where it may bounce down after hitting that ceiling, as we can see here. Now, this analogy is good, but imperfect, because oftentimes the ball may break down through the floor, and that's called a breakdown, without bouncing up, or may break out above the ceiling without bouncing down, and that's called a breakout. Now, in terms of that, there are many breakouts, but for these purposes of describing support and resistance, let's just keep with this illustration here. Okay, so how does this all relate to options? Well, let's take a look at a market where I've taken the liberty of drawing in some support and resistance levels. It's a chart of the SPX, which is the S&P 500 index. So let's take a look at that real quick. Okay, so here I have the S&P 500 daily chart, or the SPX daily chart. Now, if we see here that we have strong resistance highs, these lines that I've drawn in here are a bunch of support and resistance levels. The ones on the top are generally thought of as resistance, and the ones on the bottom are generally thought of as support. Now, one thing to keep in mind here is that support often becomes resistance when there's a breakdown, and resistance often becomes support when there's a breakout. So as we can see here, we had very strong resistance. This is acting as sort of a ceiling for that market price ball, as we can see. And then we had a breakout to the upside here, and from there, this ceiling became a floor. So support becomes resistance, becomes support, and so on and so forth. So if we take a look at these lines here that I've drawn in, and I've only drawn them in based upon past price action. So as we can see, once again here, we had a resistance ceiling here, and it became a floor, and that's what we're currently working with this particular chart. So again, we have resistance highs, and then we have support lows. And in the current price action, we have highs and lows. This high is right here, and this low is down here. And we can combine this information with our options probability assessments, like delta, to find an optimal price location to sell our calls and puts, or credit spreads, where the probability of price crossing those levels is rather low. Okay, so for example, We could place a credit spread up here, or this would be a bear call spread up here, or a bull put spread down here below support. And if we combine these with our options assessments, our probability assessments, then we have a better chance of having an edge on these particular trades. Now, this isn't to say that the market won't cross these levels, okay? They very well might cross these levels, but with strong support and resistance, the probability of it doing so is arguably lower, okay? So if you have a credit spread or a short put down below support, it's arguably a higher probability that it's not going to get hit. And same thing to the upside. If you have a short credit spread up here, or if you have a short call up here, then it's arguably less likely for price to hit that price by expiration of your spread or your short put or call. Okay, and if price does move beyond these support or resistance levels during the course of the trade, then it can serve as a signal that a strong breakout has occurred and that the trade should be somehow managed, whether simply closed or adjusted. So for example, if we have a breakdown below this support level, this is a very strong support level. If we have a breakdown below this support level, then that may be a signal. If you have an open options position, you have a short put or you have a short credit spread down below, then that might be a signal, if there's a breakdown below this support level, that somehow this options position should be managed, whether it's moved, whether it's rolled, whether it's somehow otherwise adjusted. Okay, and it can be adjusted to a lower level and a safer support level, and the same can be said to the upside if it breaches that level to the upside if there's a breakout. So there you go, just a quick and simple video on trading options using the most important aspects of technical analysis, support and resistance. And by the way, you could also use moving averages as support and resistance. You could use Bollinger Bands as support and resistance, and a host of other different tools as well. But in terms of support and resistance, and the most useful tools we found have been just the horizontal lines where you outline support and resistance according to past turns in price. Hope you found this video useful. Please head over to our website at OptionsPath.com for more information and education on options trading. We'll have plenty of quick instructional videos on trading options going forward. And from all of us at OptionsPath, thank you so much and have a great day.